Most investors seek to protect their assets during a recession by going heavy on cash and bonds, reducing the stocks in their portfolios to attempt to mitigate large volatile market drops during the volatility that occurs in a recession. But doing this could result in a big mistake in terms of loss of opportunity by capturing losses and avoiding huge market gains in the aftermath. In addition, dividend stocks tend to outperform the market in general, while dividend income keeps pouring in like clockwork. In this video, I will discuss the effects of a recession on dividend stocks and how they perform during those periods, as well as the different strategies and techniques the wealthy use to build wealth over time using dividend income. By following these easy steps, you can make your portfolio recession-proof and substantially increase your wealth during these periods of uncertainty. Get ready. You are now entering the Academy. Dividend income is one of the 7 main flows of income millionaires use to create wealth. Let's start off with the basics. What is a dividend? A dividend is a payment made by a corporation to its shareholders, usually as a distribution of profits. When a corporation earns a profit or surplus, the corporation is able to reinvest the profit in the business and pay a proportion of the profit as a dividend to shareholders, also referred to as dividend income. Not all companies offer dividends. Dividend yield represents the annual return that is expected to be paid out in dividends. So for example, a dividend yield of 3.2% represents an annual return on investment of 3.2%, broken up into quarterly or monthly payments, usually paid out every 3 months or monthly respectively. Although it is taxed as regular income, dividend income can be scaled into a substantial income-producing asset for your personal portfolio. Through careful planning and diligent investment of capital, as well as reinvestment of dividends, one can create a dividend income stream that can provide substantial income even to cover everyday expenditures and beyond. What stocks perform the best during recessions? There are 3 key ways that investors can go about recession-proofing their portfolios. The first is to invest in stocks that have historically generated lower than average volatility but superior total returns compared to the broader market. High-yielding dividend growth stocks have historically proven to be the best performing asset classes. Between 1928 and 2017, a time period that includes the Great Depression and 2 other 50% plus market crashes, the highest yielding stocks in the S&P 500 generated total returns of approximately 11.2% annually. More importantly for investors, they did this while enjoying over 30% less volatility than stocks that did not pay a dividend. As a result, their risk-adjusted returns were far superior over this period. As can be seen, during the 2008-2009 recession, the S&P 500 dropped significantly, while the S&P 500 trailing 12-month dividends dropped a small amount in 2009, but soon recovered and continued on its dividend growth path in subsequent years. Dividend income producing companies keep paying dividends like clockwork, year in and year out, and sometimes dividend income grows substantially while a recession is occurring. In this table, you can see that historically during big recessions, on average, dividend growth for the S&P 500 far outpaced S&P 500 returns, with an average of 34% loss on investment, while dividends only dropped 0.5%. The tail of this graph is that blue chip dividend paying companies continue growing their dividends even during recessions and bear markets. The second way to recession-proof your stock portfolio is to focus on dividend growth stocks such as the Dividend Aristocrats, which are S&P 500 companies that have increased their dividends for at least 25 consecutive years and thus have demonstrated their ability to maintain stable business models, strong balance sheets, and conservative corporate cultures. Due to their resilient qualities, the Aristocrats actually managed to generate positive returns during the 2000-2002 bear market in stocks and fell just 22% in 2008 compared to a 37% decline in the S&P 500. This shows the power of investing in safe dividend growth blue chips during troubled economic times. More broadly, dividend-paying stocks have consistently recorded significantly less volatility than non-dividend payers over the course of many decades. In this table, you can see the total returns for the Dividend Aristocrats versus the S&P 500 from 2000 to 2017. You can see that dividend stocks tend to be much less volatile than their counterparts, largely due to the fact that dividends tend to be much more stable than relying on pure earnings and valuation-only based stocks, which creates a more stable foundation for total returns. The third way to recession-proof your portfolio is to consider shifting your stock portfolio towards defensive sectors. Defensive sectors are those sectors whose business models are the least affected by a recession historically, because they provide essential goods and services that consumers continue to buy even during an economic downturn. Historically speaking, consumer staples, healthcare, utilities, and telecoms have been the most recession-proof sectors. Their sales are least affected by the state of the economy since they sell essential products and services such as food, electricity, telephone and internet services, as well as medicine. A well-diversified portfolio spanning across all of these defensive sectors while focusing in on Dividend Aristocrats provides the best recipe for recession-proofing your portfolio. In addition to considering Dividend Aristocrats as a large portion of your stock portfolio, a critical part of the process to fully recession-proofing your portfolio is selecting the right combination of cash, bonds, and stocks to hold that will maximize your chances of meeting your long-term financial needs while navigating troubled waters during a recession. With that said, there are a few broad rules of thumb that investors can look at to prepare for a recession. First, it is recommended that retirees hold 2 to 3 years of living expenses in cash reserves to help get through more severe market environments without needing to liquidate assets during a recession. Second, maintaining the right mix of assets, stocks, bonds, and cash can both minimize your unrealized losses during a bear market and help ensure that you have adequate financial resources to cover living expenses. As a result, you can be in a better position to remain calm and avoid panic selling quality stocks into a declining market. For example, a portfolio of 40% stocks, the S&P 500 index fund, and 60% bonds, also index funds, would have suffered a 14.9% decline in 2008 compared to a 37% decline in the S&P 500. This is an example of an asset allocation that benefits from the wealth building power of stocks, but is still heavily focused on preserving existing wealth and minimizing volatility during recessions and bear markets. And if the stocks are Dividend Aristocrats instead of growth stocks, or even the S&P 500 index funds, the returns could be much higher. Asset allocation is key, however. Consider this graph, which shows different asset allocations from ages 60 to 80 plus. Generally speaking, the younger you are, the more heavily tilted you can have your portfolio towards stocks, which tend to show more growth potential than fixed income assets such as bonds or cash. Younger investors in their 20s and 30s can be as heavily invested into stocks as 90% while still following the principles mentioned in this video, such as investing in Dividend Aristocrats, properly diversifying, dividend reinvesting, etc. Third, time in the market is better than trying to time the market. By being invested in safer dividend growth stocks that pay dividends over time and dollar cost averaging into the market on a consistent basis year in and year out, one can ride through the rough patches of economic recessions and bear markets while consistently growing their portfolio over time. This has been proven to be the secret formula for investors to creating massive wealth over time. If you'd like to learn more about dividend investing, check out my video titled How to Invest in Dividend Stocks, Wealth Creation Using Dividend Income. Investing in dividend income producing assets can be the smartest and safest investment for those looking to creating wealth over time. By employing the recession-proof strategies mentioned in this video, and with safe and smart investing techniques discussed in other 10X Academy videos, such as value investing, dollar cost averaging, and dividend reinvestment and diversification, you can create a low-risk dividend income flow that will grow over time and continue to pay income continuously. Through careful planning and diligent investment of capital, as well as reinvestment of dividends, one can create a dividend income stream that can provide substantial income, eventually covering everyday expenditures and beyond. Check out the links in the description on how to start investing in dividend income producing stocks and which vehicles you can use to start your path toward financial independence and freedom. Thank you for watching this video. Please make sure to smash the like button if you enjoyed watching. It really will help out this channel and bring more wealth creation strategy videos to the masses. And if you haven't done so already, be sure to subscribe to the 10X Academy channel. And don't forget to turn on the notification bell to be alerted on more passive income strategy videos. This is the 10X Academy.